But even on the large cap front, when I look at a company like Roblox, I mean, Roblox is not the same as Rivian. They're both trading around whatever, $75 or so, wherever they are. Roblox has a $40 billion valuation, but generating close to $2 billion in sales. And those sales are growing. Their users are growing. The amount of time spent on that platform is growing. Plus, you're seeing companies like Nike and others, because they have the whole metaverse set up already, are asking Roblox to build this Nike world, which is a great growth model. It's where the world's going. You don't see a $1 trillion company like Meta or Facebook change its name to Meta without really knowing for a fact of how big this trend is going to be. And they have a pretty good track record of getting into things early. But then you have Rivian with a $60 billion valuation generating $1 million in sales the past 12 months. Two totally different companies. Should they both be down over 40% from their highs? No. I think Roblox is a screaming buy here. Could it go lower? Absolutely. But if you're looking 12 months, 24 months, this is a great name at this price. I mean, it's just $120. Now it's what, 70, 75? Should it be in the same boat as Rivian, who really has high expectations? And I believe they do have the best technology in battery space, in the EV space. But there's huge expectations for Rivian, and everyone else is coming out with EV vehicles at the same time. And Roblox is almost on an island by itself. Yes, you have Meta, but how many companies, they're doing their own thing. This is a people saying, hey, you know what? I believe in the metaverse. Where do I go? Roblox. Maybe there's Decentraland. Maybe there's Sandbox. There's not a lot of options out there where this stuff is ready. You can build it right away. Looking at Best Buy at a 52-week low. Best Buy's at a 52-week low? Trading at 11 times forward earnings? The market's trading at 19 times forward earnings. They're growing earnings at 20% year over year, right? That's what we're expecting over the next year. 20%. Even if that slows to 10% and 11 times forward earnings, should be trading at a 52-week low. More people buying homes. Yes, it's slowing, but they sell a lot of smart home technology. TVs flying off the shelves. You have AR, VR, massive trend. New phones being sold through. I mean, they have a nice growth model there. But really, should that stock be trading at a 52-week low and down 30%? I mean, you're looking at those Monday lows. And again, 9 out of 10 stocks in the Monday low, 9 out of 10 were down, but that marked it. When we were at the low, that marked the worst start to the markets in 90 years. And this wasn't due to COVID. This wasn't due to some crazy credit crisis, over leverage. Yes, we're leveraged here, but it's all based on something that we see coming. That risk we see coming. And yes, inflation's going to be a little bit worse and maybe it stays higher than expected, but the Fed, look, they may raise rates right away. They're looking to raise rates right away, but they might halt it and say, look, we'll see inflation go a little higher because we can't afford the stock market to go down 30, 40%. The Fed's not going to allow that somehow. They really can't do much, but maybe they're like, okay, we stop the bond buying, but we don't get too crazy and maybe push it out a little bit. Who knows? But there's a lot of positives to this market where not everything should be down this much. And the opportunities I'm seeing are incredible. And I like being an optimist here because everyone on CNBC who was totally freaking optimistic in November and even when the market sold off, oh, it's great. We know the risks. Everything's great. You got to buy Snowflake at 350, which is wherever 250 today. Now everyone's more nervous than they've ever been, which is, typical for TV, right? I mean, they're going to tell you, how they feel after something happens. The market's crashing. Well, you should sell. Well, you should have told us to sell 2 months ago. But now you're watching all the headlines, the leverage coming out of the market, a lot of stocks getting nailed, bad news, and that's all you see, and everyone's reading, worried about their portfolios. Times like this is when you want to be a buyer. You don't see it often. Where a total sell-off results in great names falling 30% plus. It's happening because leverage coming out of the market resulting in every asset or stock being sold. I mean, I could see that during COVID where the markets got wrecked from mid-February through March 8th. And they got wrecked, and I understood it. But then stocks fell another 17% over the next week. The S&P fell from 2,700 to 2,200 from March 8th to March 15th. Did we deserve that big of a sell-off? No, that was a capitulation, the puking stage. Holy shit, we got to get out of the markets. We saw the same thing during the credit crisis, where stocks looked like a screaming buy in December 2008. And if you look back, it was. The S&P 500 was at 900. And what is it, at 4,300 today? It was a screaming buy. So many people said, that's it, we're good. But people forget from December to January, the S&P 500 went from 900 to 666 at the lows. Okay, about 2.5 month stretch. So the markets fell another 25%. A lot of that was just people, leverage coming to the market. We have to sell. And that provided an unbelievable opportunity. I mean, not only was it an opportunity when you at 900, but yes, you dealt with that huge, market collapse, 25% plus from January to March. But man, look where the market, you had to wait pretty much 6 months to really see this market take off from there, and it just kept going and going and going. So my point is, take advantage of the sell-off. Don't go crazy. Don't go reading crazy headlines. Don't go nuts. And we know the risks ahead of us. We could see them. I've been warning you about them. Higher rates, slower growth. But this is a positive for companies with what? With strong balance sheets? Those that continue growing earnings more than 8% annually? You just have to find those names. I say this, and maybe I was early saying this for the last couple of years, saying it's a stock picker market. That means you can't just throw a dart and everything's going to go up and numbers don't matter and fundamentals don't matter. You need someone that knows what they're doing that can find these hidden gems, because there's a lot of great names out there that are down 30% plus just because leverage coming out of the market, there's forced selling, and that provides a massive, massive opportunity. I wish that was the conversation they were having on CNBC instead of saying, it could get a lot worse. It looks terrible. The Fed's going to raise. We know what the Fed's doing. What the fuck? We knew since November. And then what? We increased it from 3 rate hikes to another one. They pushed up, the tapering timetable. We get it. It's all there. That's what's crushing the markets on something that we see. And maybe it's a little bit worse, but should stocks be down 30% plus? A lot of great names? Not on this. Definitely not on this. Especially we're going to see the market open up, supply chain issues ease, inflation slowly come down from here, which will result, hopefully, in the Fed not raising rates 4 times or just not easing, but just, slowing down that pace, which is going to be great for the markets because that's not factored in. That's definitely not factored in. So there's dozens of names I'm seeing, which I'm really excited about. These are names that you're going to see make their way into my newsletters. It's going to be volatile. I'm not going to lie. It's going to be a little crazy. But over the next 12 to 24 months, the gains in some of these names that I'm seeing that collapse could easily be up 100% plus in 12 to 24 months. That's how much they sold off, even though nothing has changed within the company other than the Fed taking leverage out of the market and raising rates, which is a positive for some companies. If you have a strong balance sheet, you're paying a dividend. This isn't the worst thing for some companies. It's bad for companies that aren't generating earnings and have these crazy growth profiles that are going to grow, discounted cash flow models going out 15 freaking years, with them generating, like Rivian, $50 billion in 2033. Now you got to be careful. I mean, having access to the debt markets is not going to be as cheap. And wages rising, of course, is not a good thing because that's going to increase costs for company. But you'll see wages come down as, we see companies cut their R&D and cut back because it's an uncertain market. But a lot of this is going to be positive. It's going to bring inflation down, not down to 2%, but off of 7%. And we shouldn't see every name down 30% plus because of this. Should some of them be down? Some of them should be down 50% plus. And a lot of those names are not in our portfolio. But 30% plus with a lot of these names, great, great opportunities.